Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine group or consolidated statement of cash flows, IAS 7, using question from ICAN November 2024, financial reporting question number 3 as worked example. If you are coming across my lecture for the first time, please like the video and share it with others. If you are a returning subscriber, I say thank you for being part of this channel. The following features are peculiar to the group financial statement. Features of group financial statements. Those features that distinguish the group financial statement from the financial statement of a single entity. Number one, you may have goodwill on acquisition of the subsidiary, which is the excess of the purchase consideration over the fair value of the net identifiable assets acquired. Then, another features may have the investment in associate. Investment in associate. Remember, an associate is an entity over which the investor has a significant influence. So, then 3, we have the non-controlling interest. Non-controlling interest. No, the non-controlling interest will arise in the case of partial acquisition. That is, acquisition of less than 100% interest in the investee. So that is when you have the non-controlling interest. Number 4, retained earnings. Retained earnings attributable to the parent. These are the features of the group. So, and each of these items will need to be calculated on group financial statement. But in this video, I will be considering the acquisition of subsidiary during the year. Acquisition of subsidiary. During the year. During the year. Acquisition of subsidiary during the year. So you will need to calculate goodwill. Let me see, working 1. Goodwill. So I will advise you watch my video on statement of cash flows of a single entity, because this lecture is to complement what I have explained in that video, meaning that I will not need to duplicate what I have explained in that video here. I will only consider those features which were not examined in a statement of cash flows of a single entity. So you have goodwill. Your goodwill is purchase consideration. Purchase consideration. Your purchase consideration could be any of this. Cash consideration. Cash consideration. It could be share consideration. It could be deferred consideration. Deferred consideration. If it is a deferred consideration, you need to discount it. What you need here is the present value of the deferred consideration. Then you may also have contingent consideration. Contingent consideration. You add all this consideration, you have the total purchase consideration. Then you have the non-controlling interest. Non-controlling interest on acquisition of subsidiary. Then you deduct the fair value of net assets at the date of acquisition. Then you have the goodwill on acquisition of the subsidiary. Working 2, you have the movement in goodwill. Movement in goodwill. Remember, in all our workings, we normally start with our opening balance. When you are ascertaining the movement in a particular item, opening balance. That is opening balance, your goodwill. Remember, Two statements of financial position will be given. One for the previous period and the one for the current period. The balance in the previous period under non-current assets, that is what you have as the opening balance here. Then acquisition of subsidiary during the year. Acquisition of subsidiary during the year. The goodwill calculated using this format in respect of the subsidiary during the year. The one calculated using this format. So where subsidiary is acquired during the year. Then you deduct the closing balance. Closing balance. Then where this total is greater than the closing balance, that means you have goodwill written off. Goodwill written off. Or impairment of goodwill. This goodwill written off or impairment of goodwill will be adjusted when you are using direct method. You adjust it under operating activities. You add it where you add your depreciation. Please take note of that. Working number 3. We have investment in associates. Investment in associates. Let me say movement, because this will have been given. Movement in investment. In associates. It is the movement you need here. Since the group financial statement is a prepared financial statement, as usual, you start with the opening balance. Opening balance. This opening balance, investment in associates, may be found under non-current assets, but where it is held for sale, you may have it under current asset. Then we have share of associate profit. Share of associate profit. This will be obtained from statement of profit or loss. Statement of profit or loss. Share of associate profit. You add this, then you deduct the closing balance. Closing balance. The closing balance. If you subtract the closing balance, then the difference will be dividend received. Dividend received from associate. Dividend received from associates. Working number 4. Calculation of non-controlling interest or movement in non-controlling interest. Movement in non-controlling interest. So, as usual, we normally start with the opening balance. Opening balance. Balance. Then you add the NCI, non-controlling interest, of subsidiary acquired. Subsidiary acquired during the year. During the year. NCI of subsidiary acquired during the year. Then NCI in statement of profit or loss. NCI in statement of profit or loss. You sum them up. Then you have the closing balance. Closing balance. You subtract the closing balance. Then you have dividend paid. Dividend paid to NCI. So that is work number 4. Then the next one is movement in retained earnings attributable to the parent. Remember, this video is to complement my earlier videos on IAS 7 statement of cash flows. I have video on direct method. I also have video on the indirect method. So, working number 5, movement in retained earnings attributable to the parents. So, as usual, you start with the opening balance. Opening balance, that is the retained earnings as at the beginning of the period. Then we add parent share of the profit for the year. You add that, then you subtract the closing balance. Closing balance. Then you have dividend paid. Dividend paid to the shareholders. Holders of the parent. Working number 6. Calculation of net cash flow on the acquisition of the subsidiary. So, and this will be reported under investing activities. Investing activities. Take note of this. Now, to calculate this, you start with purchase consideration. Purchase consideration. It is only the cash consideration that will be used. Cash consideration. You don't need to consider any other forms of consideration apart from cash consideration here. Where cash are acquired from the subsidiary, you less cash acquired. Less cash acquired from subsidiary. From subsidiary. You also, if the bank balance or bank balances are acquired, you also deduct it. Less bank balance acquired from subsidiary. Then, if a bank overdraft is acquired, you add it. You add bank overdraft acquired from subsidiary. You have the bank overdraft acquired from the subsidiary. Then after this, we have the net cash paid on acquisition of subsidiary. I've told you this amount will be reported under investing activities. Investing activities. Please take note of this. This video, I've told you, for completeness, go through my earlier video on IAS 7, statement of cash flows. I have a separate video on direct method, and I have a separate video on indirect method. ICAN November 2024, financial reporting question number 3. On October 1st, 2022, Papaya PLC acquired 90% interest in Bafana Limited by issuing 1 million ordinary shares at an agreed value of 2 naira per share and paying 1 million naira in cash. At that time, the net assets of Bafana Limited were as follows, amounting 1,000 naira. Property, plant and equipment, 1,900. Inventories, 700. Trade receivables, 300. Cash and cash equivalents, 100. Trade payables, 400. Total, 2,600. The consolidated statement of financial position of Papaya Group PLC as at December 31st were as follows. We have 2022 and 2021. Non-current assets amounting 1,000 naira. Property, plant and equipment 25,000 and 23,000 for 2022 and 2021 respectively. Goodwill 660. Total we have 25,660 and 23,000. Current assets, inventories 14,500 and 12,000 for 2022 and 2021 respectively. Trade receivables 13,700 and 11,000. Cash and cash equivalents 760 and 500. The total current asset is 28,960 and 23,500. Total assets 54,620 and 46,500 for 2022 and 2021 respectively. Equity attributable to owner of parent, ordinary share capital of ₦1 each. 2022 11,500, 2021 10,000. Share premium account 6,500 and 5,000 for 2022 and 2021 respectively. Retained earnings 17,910 and 15,300. Total equity attributable to the owner of parent is 35,910 and 30,300. Non-controlling interest 310 and nil. Total equity is 36,220 and 30,300. Current liabilities, which include trade payables 16,900 and 15,200. Income tax 1,500 and 1,000. Then the total current liabilities is 18,400 and 16,200 for 2022 and 2021 respectively. Total equity and liabilities 54,620 and 46,500. The consolidated statement of profit or loss for the year ended December 31st, 2022 amount in thousand, revenue 100,000, cost of sales 75,000, gross profit 25,000, administrative expenses 20,800, profit before taxation 4,200, income tax expense 1,500, profit for the year 2,700, profit attributable to owner of Papaya PLC 2,610, non-controlling interest 90, total 2,700. The statement of changes in liquidity for the year ended December 31st, 2022 extract was as follows. Retained earnings amount in ₦1,000. Balance as at December 31st, 2021 15,300. Total profit for the year 2,610. Balance at December 31st, 2022 17,910. Additional information. 1. All other subsidiaries are wholly owned. 2. Depreciation charge to the consolidated statement of profit or loss amounted to ₦2.1 million. 3. There were no disposals of property, plant, and equipment during the year. 4. Goodwill is not impaired. 5. Non-controlling interest is valued on the proportionate basis. Required. Prepare consolidated statement of cash flows for Papaya PLC for the year ended December 31st, 2022, using indirect method in accordance with IAS 7, statement of cash flows. Now, let's have the solution to the question. The name of the entity is Papaya PLC, and the accounting period is year ended December 31st, 2022. Now, let's have the title. Solution. The name of the entity is Papaya PLC. So we want to have consolidated statement of cash flows for the year ended December 31st, 2022. We have Naira and triple zeros. Naira and triple zeros. The first heading will be operating activities. Operating activities. So we start with profit before taxation. That is 4,200. Profit before taxation, 4,200. We now have adjustments for, now let's go through the phase of the statement of profit or loss. From the beginning of the statement of profit or loss to where we have profit before taxation. So to see if there are any items that will require adjustment. Revenue, cost of sales, gross profit, administrative expenses. The items we have there doesn't require any adjustment. So let's go to the additional information. Note 1, all other subsidiaries are wholly owned. 2, depreciation charged to the consolidated statement of profit or loss amounted to 2.1 million. Depreciation is not a cash flow, so we will need to adjust for that. So depreciation, $2.1 million. Note 3, there were no disposals of property, plant, and equipment during the year. So note 4, goodwill is not impaired. Note 5, non-controlling interest is valued on the proportionate basis. Now, let's add. The only item we have that requires adjustment is depreciation. So we now have 6,300 as the total. That is net cash flows from operating activities before change in working capital. Change in working capital. WC, I mean working capital. So we now deal with changes. Changes in working capital for the period. Remember, working capitals are current assets and the current liabilities. So now let's check our current assets and the current liabilities. Our current assets include inventories, 12,000 and 14,500. So what happens to it? And certain inventory were acquired during the year, 700. So you take the opening balance, 12,000 plus 700, that will be 12,700. If you compare with the closing balance is greater than that. So that means you have increase in inventories. Increase in inventories. Opening balance is 12,000. Opening balance 12,000. Inventory acquired 700. Then the closing balance 14,500 plus 700 minus 14,500. How much is the increase? 12,000 plus 700, that is 12,700 minus 14,500. So you have increase of 1,800. Remember, increase in asset is minus. So we subtract this. Then, trade receivables. The opening balance is 11,000. Trade receivables acquired 300. 11,000 plus 300, that will be 11,300. And the closing balance is still greater. So that means you have increase in trade receivables. Increase in trade receivables. Opening balance 11,000 plus acquisition 300. 11,000 plus 300 minus closing balance. Trade receivables, the closing balance is 13,700 minus 13,700. Since it is an increase, trade receivable is also an asset. We subtract the increase. 11,300 minus 13,700. So you have 2,400. So you subtract 2,400. Please, for better understanding, watch my lecture on IAS 7, Statement of Cash Flows, using indirect method for a single company or single entity. Then cash and cash equivalent, that will not be considered. So we exclude that. Then the current liabilities, we consider trade payables. Trade payables, I never knew if it is an increase or decrease. Trade payables. We consider the opening balance plus acquisition. Trade payables acquired during the year amounted to 400. Cash equivalent will not be used as part of the changes in working capital. So we have plus 400. Remember, I told you we normally exclude cash or short-term investment. We exclude them or items to be treated net of operating activities. We are going to exclude those items from changes in working capital. So the opening balance plus acquisition, this 400 acquisition minus closing balance. So I need the opening and closing balance here. The opening balance, trade payables, opening balance is 15,200, while closing balance is 16,900. So opening balance 15,200, closing balance is 16,900. So how much? 15,200 plus 400, that is 15,600. The closing balance is still greater. That means we have increase in trade payables, increase in trade payables. So 15,600 minus 16,900. So we have 1,300. Increase in liability is plus. Trade payables is a liability, so we add that since it is an increase. Income tax will be used to calculate the tax paid. So what will now be the total of all these items? Minus 1,800 minus 2,400 plus 1,300. So we have 2,900 minus 2,900. So minus 2,900 plus 6,300. We have 3,400. That is net cash flows from operating activity before tax. The next item will be taxes paid. Taxes paid. Let me have that as working number 1. Taxes paid. Working 1. Working 1. Taxes paid. As usual, in all our workings, we normally start with the opening balance. How much is the opening balance in respect of tax? Under current liability, 2022 is closing, while 2021 is opening. So that means the opening balance is 1,000. 1,000. That is the opening balance. Then we now go back to the statement of profit or loss. You have tax expense. Tax expense, that is from statement of profit or loss. We didn't have any deferred tax because there are no non-current liability. From the statement of profit or loss, we have income tax expense, 1,500. Income tax expense, 1,500. If you add the 1,500 and 1,000, then you have 2,500. The next item should be the closing balance. Closing balance. We subtract the closing balance. Back to the statement of financial position, income tax. The closing balance is 1,500. 1,500. If you subtract the 1,500 from 2,500, then you'll be having 1,000. That is the tax paid. Tax paid. This amount will be shown as operating activity in our statement of cash flows. Tax paid is 1,000. If you subtract 1,000 from 3,400, then you'll be left with 2,400. That is net cash flows from operating activities. Net cash flows from operating activities. After operating activity, the next heading will be investing activities. Investing activities. If you have watched my earlier videos on IAS 7, both direct method and indirect method, I've told you whenever you get to this section that you should always check the movement in non-current assets. Investing activities are those activities that result in changes in non-current assets and investments. Non-current assets include property, plant, and equipment. Now, working number 2. Working 2. Movement in property, plant, and equipment. Movement in property, plant, and equipment. Remember, in all our previous workings, we normally start with the opening balance. Opening balance. How much is the opening balance? 2021, which is 23,000. 23,000. Then acquisition of Bafana Limited. Acquisition of Bafana Limited. Property, plant, and equipment were acquired, and that amounted to 1,900. 1,900. Then in note 2, we have depreciation. Additional information 2. That is where we got this depreciation from, and that amounted to 2,100. We subtract depreciation. Then, what do you have after this adjustment? We have 22,800. 22,800. Then you consider the closing balance. Closing balance in respect of property, plant, and equipment. Then we have property, plant, and equipment. That of 2022, the closing balance, which is 25,000. 25,000. If you subtract the closing balance minus 25,000, then you have 2,200. The closing balance is greater. That means you have acquisition of property of PPE. So you recognize that as investing activities. Acquisition of PPE. That is working number 2. Where that is 2,200. Acquisition is an outflows. After property, plant, and equipment, the next item is goodwill. We have goodwill of 616 in the closing balance, but nil in the opening balance. So, on the basis of that, we will need to calculate goodwill on acquisition of Bafana. So, now, let's have work number 3. Working 3, acquisition of Bafana Limited. Remember, Bafana is a subsidiary that was acquired during the year. To calculate goodwill, you start with purchase consideration. Purchase consideration. And we have two forms of purchase consideration in this question. On October 1st, 2022, Papaya PLC acquired 90% interest in Bafana Limited by issuing 1 million ordinary shares at an agreed value of 2 naira per share. This is the share consideration. If you have watched my earlier videos, I've told you we have different forms of purchase consideration. We have the cash consideration, we have share consideration or share exchange, we have deferred consideration, as well as contingent consideration. Those are the 4 types of purchase consideration we have in group account: cash consideration, share consideration or share exchange, contingent consideration, and deferred consideration. I've explained those forms of purchase consideration in my earlier videos on group accounts. Please, I will advise you go back to those videos for better understanding. Now, this is a share consideration by issuing 1 million ordinary shares at an agreed values of 2 naira per share. So the first consideration I'll be examining is share consideration. Share consideration, which is 1 million shares, which was issued. Price is 2 naira times 2 naira per share. That will be 2 million naira. Then we also have cash consideration. Cash consideration. You were told, I'm paying 1 million naira in cash. This is a cash consideration. If you add that, then plus 1 million, then that means the total consideration will be 3 million naira. That is the total consideration, which comprises the cash consideration plus the share consideration. Then the next item to consider is the non-controlling interest. Remember, on 1st of October 2022, Papaya PLC acquired 90% interest in Bafana. Since 90% were acquired, then the remaining 10% will be attributable to the non-controlling interest. The next item is non-controlling interest. Non-controlling interest. Remember, if you have gone through the notes here, note 5, we're told non-controlling interest is valued on the proportionate basis. That is additional information number 5. Since it is proportionate, the percentage attributable to the non-controlling interest is 10%. If you subtract 90% from 100%, you'll be left with 10%. So you calculate the 10% of the net asset at the date of acquisition, which is 2.6 million. So we have 10% of 2.6 million. That will give us 260,000. If you add it to 3 million, that will be 3,260,000. You now subtract the net assets. Net assets at the date of acquisition. And the net asset at the date of acquisition is 2.6 million. 2.6 million. If you subtract the 2.6 million from 3,260,000, then you'll be left with 660. That is the goodwill on acquisition of Bafana Limited. So working for movement in goodwill. Opening balance. Opening balance. is nil. Acquisition of Bafana Limited. Goodwill on acquisition of Bafana Limited, as calculated, we got 660. 660. Total will be 660. Then we'll deduct the closing balance. Closing balance. And the closing balance given in the statement of financial position under non-current asset is 660. So if you subtract the 660, then you'll be left with nil. Then the next item, we have the net cash paid on acquisition of Bafana. The net cash paid on acquisition of Bafana Limited. Net cash paid on acquisition of Bafana Limited. Let's have that as working number 5. Working 5. Net cash paid on acquisition of Bafana Limited. You start with the cash consideration. Cash consideration. Now, where the information were provided about the purchase consideration, remember the issue shares, 1 million ordinary shares, that does not involve cash at an agreed value of 2 naira per share. So the share consideration doesn't involve cash. I'm paying 1 million in cash. It is this 1 million that is cash consideration. So you have the cash consideration of 1 million. 1 million. Then you check the items acquired. Cash and cash equivalent. Cash were acquired of 100. So you have to subtract the cash. If it is back overdraft that is acquired, you add it. But being a cash, the cash balance acquired, you deduct it. So cash acquired. Cash acquired. And that amounted to 100. You subtract that 100. Then the net cash paid on acquisition of Bafana will be 900. So 900 outflows. There are no other items that will fall under this heading. Therefore, net cash flows. Net cash flows from investing activities. So now let's sum it up. 2,200 plus 900. So we have 3,100 negative outflows. After investing activities, the third heading will be financing activities. Remember, I've told you that whenever you get to this section of statement of cash flows, that you should always check the movement in equity and borrowings. The borrowings I'm referring to, they are form of loan notes. We normally have them under non-current liabilities. Let's check the movement in equity shares. Working number 6. Movement in equity shares. As usual, we normally start with the opening balance. We have the opening balances. Opening balances, which comprises the opening balance of ordinary share capital, ordinary share capital. This is 2022 and this is 2021. The opening balance is that of 2021, which amounted to 10,000. 10 million. Then We also have share premium account. The opening balance, share premium. You have 5,000, which is 5 million. Then if you go back to where you have information about acquisition of Bafana Limited, at the beginning of the question, we have share consideration. 1 million shares at 2 naira per share. 2 times 1 million, that will be 2 million. If you sum up this, then you have 17 million. 17 million. Then the closing balance. Closing balances. We have ordinary share capital. The closing balance is 11.5 million. Then we equally have share premium. The closing balance is 6.5 million. If you sum them up, then you have 80 million. If you subtract 80 million from 70 million, then you have 1 million. That 1 million represents the issue of shares during the period. Issue of shares. Then, under financing activity, you have issue of shares. Working number 6, 1 million naira. Proceed from issue of shares and inflows. Then, as part of our equity, you have retained earnings. Working number 7, movement in retained earnings. We are checking the movement in equity. So, as usual, you start with the opening balance. Opening balance. How much is the opening balance of retained earnings? The opening balance is 15.3 million. 15.3 million. Then, profit for the year. Go back to the statement of profit or loss. Profit for the year. From the statement of profit or loss. From the statement of profit or loss, you have the profit attributable to owners of Papaya PLC. That is 2,610,000. That is the one we need, not the total profit for the year of this. No, the profit for the year was shared between Papaya PLC and the non-controlling interest. So the one that goes to the parent, which is 2,610,000. That is the one we need for now. The profit for the year is 2,610. So if you add it, so 17,910,000. Then you have the closing balance. Closing balance of the retained earnings. The closing balance is 17,910,000. 17,910,000. So there is no difference there. So that means there is no dividend paid. Dividend paid will be nil. That will be nil. But if this is greater than the closing balance, the difference will represent the dividend paid. Then that is all about the equity attributable to the owners of the parent. As part of equity, we have non-controlling interest. Working number 8. Movement in non-controlling interest. As usual, in all our workings, we normally start with the opening balance. So we have the opening balance. Opening balance. Then non-controlling interest. The opening balance is nil. Then Let's go through the statement of profits or loss, and we also have acquisition of Bafana. Acquisition of Bafana Limited. Then we also have the statement of profit or loss. The non-controlling interest there. 90% of Bafana Limited were acquired by Papaya PLC. That means the remaining 10% not acquired will be attributable to non-controlling interest. Therefore, you calculate 10% of 2,600. That will be, the total net asset on acquisition of Bafana is 2,600. So 10% of 26, that will be the non-controlling, that is the non-controlling interest on acquisition of Bafana. Then in the statement of profit or loss, we have profit attributable to we have owners of Papaya, then we also have non-controlling interest, that is 90. So we will equally consider the 90. NCI in the statement of profit or loss is 90,000. Then acquisition of Bafana, which is 10% of 2.6 million, as I've said, and that will be 260. 260 plus 90. That gives us 350. Then the closing balance in non-controlling interest, closing balance. Then non-controlling interest, closing balance is 310. 310. You subtract 310 from 350, you'll be left with 40. That is dividend paid to non-controlling interest. Dividend paid to NCI. That is working number 8. So dividend paid to non-controlling interest, working 8. That is 40. 1,000 minus 40. That will give us 960. Net cash flows from financing activities. That is 1,000 minus 40, which is 960 inflows. Then net cash flows from operating activities. We have 2,400 inflows minus 3,100 outflows plus 960. We have 260. That is net cash change. Then now consider cash or cash equivalent at the beginning. Then after adding this, you will get or cash equivalent at the end. Back to the statement of financial position. Then under current assets, we have cash and cash equivalent. The one at the beginning is 500, while the one at the end is 760. 500 and 760. The one at the beginning, 500. The one at the end is 760. And if you add 260 and 500, it will give you 760. This marked the end of the solution to the question. Please help me to drop the love emoji, like the video, subscribe to the channel, and also share the video with others. Thanks for watching ZICA.